Welcome to The Explainer. Today, we're cracking open the official rulebook for pretty much every company in India. We are going to decode the legal DNA of Indian business, the Companies Act of 2013.
So you've got this amazing idea, right? You're ready to build the next big thing. But where do you even start? What's the very first non-negotiable step to turn that dream into a real, legal, functioning business? You start right here. And you've got to think of the Companies Act not as some dry, boring legal document, but as the actual blueprint. It's the instruction manual with all the rules and all the structures you need to build a company that's meant to last. All right, so let's get right into it. What exactly is this blueprint, and why was it even created in the first place? At its heart, the Act really has three main goals. First, to improve how companies are run. That's what we call corporate governance. Second, to make the rules simpler and easier to follow. And third, and this is a big one, to protect the people who put their hard-earned money into these companies. It was a massive overhaul, really designed to bring India's corporate law up to speed with the modern economy. Now, this massive change didn't just happen overnight. It wasn't like flipping a switch. It was actually rolled out in phases. You can see here, it got the president's approval in August 2013, then a batch of sections went live in September, and then a huge chunk of it kicked in by April 2014. This slow rollout gave everyone in the corporate world a chance to adapt. So, we have this blueprint, but who exactly has to follow it? Does it apply to every single business out there? Let's find out. The reach of this act is, well, it's huge. It's not just for brand new companies, but also for ones formed under older laws. And it covers specialized sectors too. Think insurance, banking, electricity. But, and this is a huge but, there's a really important exception that we need to get our heads around. Okay, this little phrase right here, it might look like boring legal jargon, but it is a giant when it comes to the law. This is the key that unlocks how the Companies Act plays with other big, powerful laws for specific industries. So what on earth does that actually mean? Here's the simple version. There's a pecking order. If you're a bank, you follow the Companies Act for general stuff. But if a rule in the Companies Act says to do one thing and a rule in the Banking Regulation Act says to do another, the Banking Act is the boss. The special law always wins on its own turf. Simple as that. Okay, now that we know who the blueprint is for, let's look at the different kinds of structures you can actually build with it. The Act gets very specific here. This is probably the biggest fork in the road when you're starting out. A private company is really defined by its limits. It restricts who can own its shares, it has a cap of 200 members, and fun fact, employees don't count toward that limit, and it absolutely cannot ask the general public to invest. A public company, well, it's basically defined as anything that isn't a private company. It's open for business to the public. Now, here's a really interesting, kind of tricky rule you gotta know. Even if a company looks and acts like a private company, if it's owned by a public company, the law treats it as if it were public. That means it misses out on all the perks and simpler rules private companies get. So who your parent company is, well, it matters. A lot. The Act also carved out this special category, almost like a fast-track lane for smaller businesses. Being a small company isn't about how many people you employ. It's a legal status for non-public companies that lets them follow a much simpler rulebook. But to get this status, you have to fit inside two financial boxes. The first test is paid-up share capital. In simple terms, this is the actual cash the company has gotten from its owners in exchange for their shares. To be considered a small company, this number can't be more than 4 crore rupees. And the second test is your turnover from the last financial year, basically your total sales. That figure can't go over 40 crore rupees. And here's the kicker. It's not one or the other. You have to be under both of these limits to get that sweet, sweet small company status. But hold on. Even if your numbers fit, you can still be disqualified. You can't be a small company if you're a holding company or a subsidiary. Same goes for a nonprofit, what's known as a Section 8 company. And finally, any company that's already governed by one of those special acts we talked about is out too. Okay, we've got the structures down. But who's actually running the show? Every building needs a crew, and the Act is very clear about who's in charge. Right at the very top of the pyramid, you have the board of directors. And notice that word, collective. It's not one person, it's the whole team. They are the ultimate decision makers responsible for steering the ship. Just below the board, the Act defines a super important group called the Key Managerial Personnel, or KMP for short.
You can think of them as the senior leadership team that's legally on the hook for the day-to-day stuff. Your CEO or managing director, the company's secretary handling all the legal compliance, any whole-time director, and of course, the CFO who's watching the money.
And finally, let's follow the money. The Act uses very specific lingo to talk about a company's financial foundation, its capital. And you know what? Getting this vocabulary right is absolutely essential.
The best way to get your head around this is to picture a funnel. Right at the top, the widest part, you have authorized capital. That's the absolute max the company is allowed to raise, let's say 2 crores. From that pot, it issues some to the public, say 70 lakhs. Then it calls up a portion of that, asking shareholders to please pay up, maybe 56 lakhs. And finally, at the very bottom of the funnel is paid up capital. This is the money that's actually landed in the company's bank account, maybe 55.52 lakhs, because someone's check hasn't cleared yet. See? Each step is just a smaller piece of the one before it.
All right, so let's boil this all down. What do you absolutely need to remember? 1. The Companies Act is the official, non-negotiable blueprint. 2. This blueprint gives you options, different structures like private, public, and small companies. And 3. Learning the language, knowing your people from your capital, that's your real first step to building something solid. We've just decoded the very core of the Companies Act 2013. We've laid out the foundation, the different models, and the key players. So the only question left, really, is the one for you. Now that you can read the blueprint, what are you going to build?